All right, Teladoc Health, the biggest virtual care company in the world, just dropped its latest quarterly report. And let me tell you, if you dig into the numbers from their CFO, there's a really fascinating story unfolding about a company at a major turning point. Let's break it down. So, you gotta ask, right? How healthy is this telehealth giant really? Well, the answer? It turns out it's a lot more complicated than you might think. In fact, when you look at their Q3 report, it's almost like you're looking at two totally different companies that just happen to share the same name. It is truly a tale of two very different businesses, each with its own story. Okay, so let's kick things off with the big picture, right? The top line consolidated numbers for the third quarter. This will give us a baseline before we start peeling back the layers here. So, they pulled in $626 million in total revenue. Now, on the surface, that sounds huge, but, and this is our first clue, it's actually down just a little bit, about 2.2% from this time last year. And that small dip tells us there's definitely more going on under the hood. But then you flip the coin over, their adjusted EBITDA, which, is a key way to measure their operating profit, came in at a really solid $70 million. And get this, that was at the high end of their own forecast, which shows they're doing a great job managing their costs. And this brings us to the first of our two stories. Let's talk about the integrated care segment. You can think of this as the company's workhorse, the stable, reliable engine that just keeps chugging along. This part of the business brought in $390 million, and that's up 1.5% from last year. The CFO was pretty clear that this steady growth is coming from strong performance overseas and just more people actually using the service for visits. And get a load of this. The user base here is just massive. We're talking 102.5 million members in the US alone. That's not just a big number, it's up 9% year over year, hitting the very top of their projections. It just goes to show you how deep their roots are in the market. And here's another really positive sign. You look at their programs for chronic care, for things like diabetes. Enrollment there jumped 4% in just one quarter alone. That's a big deal. They're now at 1.17 million members, and it signals a return to growth in a really critical area for them. All right, so that's the good news. Now, let's talk about the other side of the company, where honestly, the story is the complete opposite. This is about Better Health, their direct-to-consumer mental health business, and boy, is it running into some serious headwinds. So Better Health, you've probably heard their ads on podcasts, right? It's the service that connects you directly with a therapist. And the key thing to understand is that historically, it's been a cash pay business. You pay out of pocket, and that makes it really sensitive to how people are feeling about their personal finances. And this chart right here just lays out the problem perfectly. Outside the US, Better Health is actually growing its user base pretty well, but here at home, in its biggest market, it's seeing a decline of about the same amount. That international growth just isn't enough to make up for the slowdown here. And the CFO, Mala Murthy, she didn't mince words about this. She basically said that people are just feeling less confident about the economy, money's tight, and that uncertainty has been hanging around all quarter. When wallets get tighter, services like these can be one of the first things people cut. And this is where it gets really interesting. Kind of ironic, actually. A huge reason for this slump is that consumers now want to use their insurance for therapy, not pay cash. So that trend is absolutely hammering their old business model. But at the very same time, it proves that their new strategy to start accepting insurance is exactly the right move. So you've got this split, right? One part of the business is strong, the other is struggling and trying to pivot. What does all that mean for their outlook for the rest of the year? Let's take a look at their updated guidance. And it's no surprise, it's the exact same tale of two businesses. For the stable integrated care side, they actually raised their guidance for both revenue and profitability. They're feeling confident. But for Better Health, they had to narrow their outlook down to the lower end of what they were previously hoping for. Yeah, the numbers in this table just spell it all out. You see integrated care on track for healthy revenue growth and really strong profit margins. Then you look over at Better Health, revenue is expected to drop by 8 to 9% for the year, with way, way tighter margins. It's just night and day. But okay, hidden inside that challenge is a little seed of a turnaround. The company is expecting to bring in $12 to $14 million this year just from its new insurance initiative for Better Health. Now look, that's a small start, but it's a crucial first step in pivoting that business back toward growth. So that's the bottom line.
Teladoc is performing this delicate balancing act. It's relying on the strength of its core integrated care business to provide a stable foundation, while it completely retools its consumer-facing better health business for a new, insurance-based future. And that leaves us with the big question: can they pull it off?